This is Agriculture Today, and I'm Samantha Bennett with the K-State Radio Network. We begin today's program with K-State and Washburn University School of Law professor Roger McEowen. In this Ag Law update, Roger focuses on Social Security planning and what farmers and ranchers specifically need to know when it comes to understanding their Social Security benefits. Also ahead, the Beef Cattle Institute's Ask the Expert segment this week features K-State experts Brad White, Brian Lubbers, Dustin Pendell, and Bob Larson. They, of course, answer a listener's question on how to start their operation with the goal of growing for profit. We end with this week's Milk Lines, where K-State dairy specialist Mike Brouk encourages producers to conduct year-end evaluations with all employees. He discusses how to structure evaluations so it benefits producers and employees alike. This is our last program for the week, but from myself and the rest of us here at Agriculture Today, we wish you all a very happy and safe Thanksgiving. This is Agriculture Today. We are joined now by Roger McEowen. He is our K-State and Washburn University School of Law professor that joins us twice a month for some ag law updates. He's joining us this week because we have many producers, actually, that are reaching retirement age for Social Security benefit purposes. And there's a lot of questions that surround that subject, Roger. So thank you so much for joining us today to answer some of those.
Well, good to be with you, Samantha. And yes, this is a big issue. And if we look at just the USDA statistics in terms of the age of farmers, there's about two-thirds of all farmers out there that are age 55 and up, and a significant chunk of them that are age 65 and up. So I think one of the things about estate planning and succession planning and legacy planning is Social Security benefit planning. When should I retire? When should I put retire. Let me back up on that. I put retire in quotes because do farmers really retire? Well, I mean retire in the context of when should I start drawing Social Security benefits. And what I like to tell people is, kind of with a little smile on my face, is, well, if you can tell me when you're going to die, I can tell you how to maximize your Social Security benefits. But so it's not an exact science, not at all.
Absolutely. And because of that, like we mentioned, there's lots of questions that resolve around this subject. And I feel like the first one is pretty much, what is a typical full retirement age for people today?
Well, that's defined by the Social Administration, and that's a key concept because once you attain full retirement age, your earnings don't impact your Social Security benefits, but they do if you haven't reached full retirement age. And that age used to be 65 for those born in 1937 or earlier. If you're born between 43 and 54, your full retirement age now is 66. And then it increases in 2-month increments each year to 66 in 10 months for those that were born in 59. So if you turn, for example, somebody that turned 62 in 2022, the full retirement age is 67. So it's tied to how old you are. But basically, we can think of it as 67.
You mentioned, age obviously has to do with when you can start drawing these benefits. But what does that process look like once you reach that age?
Well, once you reach retirement age, we've got somebody that turned 66 this year, and so they're right on the cusp of full retirement age, according to the SSA. There's a monthly earnings limit of $4,330 right now, and that's for the months before full retirement age is reached. And then the point is, because if you keep working at that point in time and you're drawing benefits, your excess earnings result in a $1 reduction in your benefits for each $3 of excess earnings that you receive before you attain full retirement age. Now, for a person who hasn't reached full retirement age, benefits are reduced by $1 for every $2 of earnings over the annual limit of $19,500. That $1 for $3 reduction kicks in at $51,960 this year, and those numbers get inflation adjusted. So you have to watch how much earnings, and that's earned income. That doesn't mean certain types of passive rental income or royalty income, those types of things. But if you keep working and you're drawing benefits, you've got to watch that threshold because some of your benefits might be reduced.
Key to understand for sure. And also I feel like key to understanding benefits is the taxation of these benefits, and it can be rather messy. So on a federal level in and of itself, what does the taxing of Social Security benefits look like for many?
Yeah, messy is a really good word to explain this because this is really confusing. You could have none of your benefits taxed, or they could be taxed at a 50% level or an 85% level, depending on your situation. For example, if we've got a person that files their tax return as married filing jointly, they will subject half of their Social Security benefits to tax if the total amount exceeds the base amount. And so basically that's $32,000 for this year. It's $25,000 for a single filer. And so once you get over that threshold, you start getting your benefits taxed. Then that 50% changes to 85% of your benefits being taxed once your earnings exceed $44,000 on a married filing joint return. Those are maximum percentages in theory. There is a complex formula that often results in less Social Security benefits being taxed than the maximum percentage. So what I was citing to you were the maximum percentages. Fortunately, the IRS gives us a worksheet to calculate that. That's in an IRS publication.
Absolutely, yeah. We'll link to some of these resources that we discussed today in the show notes of today's program, which can be found on agtoday.net. But then the taxation doesn't end there, Roger. Of course, there's also state taxation as well on a lot of these benefits. So I know that differs state to state.
It does, and unfortunately, it's one of those states that taxes Social Security benefits. In Kansas, if your federal AGI is $75,000 or less, you are exempt. But once you get above that threshold, your benefits are taxed to the same extent that they're taxed at the federal level. Nebraska also taxes Social Security benefits. For 2021, they didn't tax it for joint filers that had a federal AGI of $9,960 or less, and others with a federal adjusted gross income of $44,460. So you've got these thresholds in both Kansas and Nebraska before your Social Security benefits start to be taxed at the state level. But a lot of states don't tax them. We're kind of in the minority here in Kansas as well as Nebraska in having the states tax at least some of the benefits at the state level.
Yeah, understanding if you are in one of those states, key for sure. And then those thresholds, like you mentioned, very good to know. And then there's some other good information to know for everyone that's looking to collect Social Security benefits. And that's kind of these donut hole issues that we run into. Can you kind of explain those to us?
Yeah, we usually don't know something we like. They're tasty, they're sweet, but they're bad when it comes to Social Security. And what this is, in essence, is we have two inflation adjusters when it comes to Social Security. We have a wage inflation adjustment up until age 60 because your Social Security benefits are based on your lifetime earnings. And so those earnings do get adjusted for inflation, but only up until age 60. But you can't start drawing benefits until you turn 62. And then once you are eligible for benefits, then those benefits become also inflation adjusted. That's the COLA, the cost of living adjustment that people are really familiar with. Well, if you fall in that age 60 to 62 category, you don't get a wage inflation adjustment on your wages while you're still working, and you're not eligible to draw benefits yet, so you can't get those. And the problem for people that are in that donut hole right now is there's high inflation, record inflation in the economy that we haven't seen in 40 years, 8 to 9%. And if they're still working, their wages reflected in their base will not be adjusted upwards by that 8 or 9%. So you're locked into where you were at age 60, and you're going to stay there. You're done with your inflation adjustment, and you can't be eligible for benefits until you turn age 62. That's what the Social Security donut hole is, and it's not very sweet, and there's nothing we can do about it. We can't plan around it. You're just born at the wrong time in terms of when inflation hit.
There's some specific considerations for producers specifically, so let's talk through some of those as well.
Yeah, a lot of do this because there's a tax benefit to paying wages in kind, but those wages, such as crops or livestock, they count toward the earnings limitation test because that earnings limit test includes all earnings, not just subject to Social Security tax. And, of course, we pay in-kind wages to avoid paying Social Security tax. Federal Farm Program payments that a farmer receives are not deemed to be earnings when we calculate each calendar year's earnings limitation. So that doesn't count. The only exception for that is the initial year of Social Security benefit application, because in that year, all of your FSA program payments are counted along with other earned income and your earnings for purposes of the annual earnings limitation test. But once you get beyond that, they no longer count. A lot of farmers also, when they get into retirement, they'll have cash rental income. They'll cash rent their ground out to somebody else. The cash rental income that they receive is likely treated as earnings, even though they might be getting a wage from their employer. So this would be those who cash rent farm ground to their employer. Now, that's particularly the case if the farmer is farming the ground on the employer's behalf. So that would give you a doubling up of the wage income and the cash rent income for purposes of the earnings test. A lot of farmers in Kansas have land that's in the Conservation Reserve Program. So if we have a farmer who's drawing Social Security benefits, whether they're retired or not, the CRP payments are not subject to Social Security tax. And there is a specific exemption in the code that was put in a number of years ago with respect to that. So we have some of those nuances that are specifically just to farmers.
Absolutely. And if producers are looking to retire anytime soon, or they're looking at understanding these benefits further, who might be a good resource for them to reach out to?
A lot of tax planners do this too, but particularly on this area, it would be financial planners that you want to be talking to, your investment portfolio manager if you have one, your financial planner. But keep in mind, this is all kind of subjective. If you can tell me how much you plan on making in retirement and how long you're going to live, then we can get you a good plan in place. But other than that, it's just basically knowing what the rules are and trying to figure out what might be best for you, knowing that it may not actually be best for you because we can't control all of the factors.
Absolutely. And when we talk about farm succession and things like that, this is a conversation that's often missed out on. But when it comes to planning for this phase of life, is it always better to start a bit earlier than waiting till the last minute like some might find themselves in now?
Well, I think so. Integrate Social Security benefit planning in with other retirement planning, succession planning, estate planning goals and objectives. I think we need to view it as part of the package. And often I find that it's forgotten. We just kind of, well, there it is. We'll just throw it in here. But maybe there's some optimization planning that we can do and integrate this along with other concepts that we're doing from an estate planning standpoint to try to maximize the amount of income in retirement. So a comprehensive approach is always what I suggest.
Roger, I know you recently wrote an article about this exactly on your blog, so I will link to that in the show notes of today's program, which can be found again at agtoday.net. But Roger, as always, thank you so much for your time.
Well, thank you, Samantha.
Absolutely. Once again, that was K-State and Washburn University School of Law professor Roger McEowen. We will be back with more ahead on Agriculture Today. This is Agriculture Today. We are continuing our show now with the Beef Cattle Institute's Ask the Experts. This week, we're joined by Brad White, Brian Lubbers, Dustin Pendell, and Bob Larson.
Hi, welcome to Beef Cattle Institute's Ask the Experts, where our experts will answer your question. I'm Brad White. Happy to have you with us listening today, and happy to have these guys here with me today. Hey, Brian.
Hey, Brad.
Dustin.
Hey, Brad.
Bob.
Hey, Brad.
We've got one topic I want to discuss with you guys today, and it's really based on a listener question, and it's about if I'm new to the industry, how can I start my operation and really be growing for profit? So thinking about a cattle operation, what are some of the things somebody new to the industry, how would you approach it? I'm starting with a blank slate. So I could start with stockers, cows. What would I do? Dustin?
Well, my answer, it depends. So thinking about this for a minute, when I think about profit, right, the equation to calculate profit is revenue minus costs. And so thinking about revenue, price and times quantity being weight. Price, if you're in a cow-calf competitive markets, those are kind of already set. As a producer, you don't set the price. So those are kind of given. So you can control the weight aspect of it. So that's the revenue side. Cost side, there's a lot of factors that go into it. But if I had to pick one thing, it's going to be cost, because more than 60% of the profitability is coming back to the cost side. A lot of those things I can't control.
So whichever aspect I go into as far as beef production, I got to do something where I can have some control over those costs, or I have a cost advantage over somebody else.
Yep. In fact, yesterday I was looking at the cow-calf cost data for some farms here in Kansas, and what I was noticing between pasture expenses and non-pasture feed expenses, the producers are making trade-offs. I either run my calves longer on pasture, and my non-pasture feed expenses are going down. So my pasture expenses are higher for my most profitable operations, and my lowest profit operations, actually my non-pasture feed expenses are the highest, which is the largest cost expense in any operation.
So cow-calf operation, for sure. Winter feeding costs, some of those things. That's a lot on the cost side. Bob, what about the income side?
I do think you have to focus at least quite a bit of your attention on the income side, which is basically productivity. And I'm going to start thinking about a cow-calf operation. So things like reproductive efficiency really become important. Getting a high percentage of the herd pregnant early in the breeding season, and that takes good heifer development, good cow maintenance, watching their body condition score, particularly going into the breeding season, and good bull fertility, good bull optimization, really making sure that we've got a good fertile herd. So that wraps in a lot of things, good nutrition, good health. But really what I'm looking for and what I'm going to measure is things like the percent of cows that get pregnant, the first percent of cows that get pregnant in the first 21 to 30 days, those types of things that I'm really looking for, herds that are highly productive and can generate a lot of income. I agree. You can't do that and ignore costs. You have to consider costs.
But you're kind of baking that in, because when you talk about reproductive efficiency, Dustin just told us the driver of my operation is winter feed costs. Well, who eats winter feed? Cows. And you're measuring what's the productivity per cow. So you're measuring income, sales of calves divided by cows. So I like that approach, and it kind of ties in. But to Dustin's point, that cow cost, I have to manage it. Brian, what are your thoughts?
Well, I kind of feel like the third person on a date right now, because we've talked about revenue, we've talked about costs. I'm thinking what's left. I'm going to answer the question a little bit differently, because they said they're new to the beef industry and they want to know about advice for growing profit. I think for somebody that's entering the beef industry right now, I might be worried more about risk protection than profit. I mean, you have to have profit in order to keep going, right? But I also think you need to be very aware of how deep you're getting in right now, because if you can't sustain that, then this is not a long-term deal. So I'm going to change it just a little bit, but I'll say I think I would be, and maybe risk protection fits in with costs probably more than anything, but I would be very careful and concerned about over-leveraging myself being new to the industry.
But I think that is an excellent point, because it's totally different than the cost or the revenue, because this risk protection, and I would even view it as, if I am entering the industry now and I am buying really high-priced cows or really high-priced pairs of animals, then I have to worry a little bit that there's going to be some cost erosion. Now, if I've been in the industry for 15 or 20 years, buying a few cows now is going to average them out cost-wise with the rest of my herd. If I started a herd today, what you're saying is, if I don't protect that asset, it could go down.
Well, and I use that term very generically, mostly because I don't know what it means when I say risk protection. But, I mean, I think it could be as simple as maybe I lease cows versus buying cows, or maybe I'm providing more labor than capital investment. Like, I think there are other risk protection strategies, and I'll let Dustin talk about those, like price protecting your feed and stuff like that. Obviously, you need to do that, but I'm thinking of it even more simplistically than that.
But even if you get in when prices are really high, that's eventually going to even out if you survive. Mm-hmm. But it becomes a cash flow issue, and you have to survive to get to that point. I'm going to go one other direction that you guys haven't necessarily gone implicitly, is if I'm new to the industry and I'm getting in and I wanted to grow profit, I need to find information. This is beyond just what do I do on the cows. It's stuff like you guys just said, but I need to work with people in my area. I need to work with, whether it's my veterinarian, whether it's my accountant, whether it's the ag extension agent, whoever is in my area, to get some of that information, because I don't have the ability or the flexibility to make a ton of mistakes. I'm going to make mistakes, but I want to minimize that as much as I can by starting off in the right direction, which is another way of risk management. Right, Dustin?
Yeah, so where would I start? I mean, I don't know if that's the question you're asking. I'd probably start by listening to BCI's podcast. I mean,
that's where you'd start. Yeah.
No, actually, I'd start with my local, your land-grant university. Yeah. All right, go to their extension website, whether it's the animal science department, whether it's the ag econ department, whether it's the agronomy, your range, wherever. And I would start there. You've got your local county extension agents, visit with them. That's where I would start.
But it's no different, and you're absolutely right. If you're talking about investing, right, you're going to go invest in the stock market, and somebody to ask us a question about that, we wouldn't be wrapped up in the specifics of calves weaned per cow exposed. We'd be saying, hey, we better go learn about this from somebody that really knows investing in the stock market. Well, you're not doing anything different here. If you're starting an operation, you're investing in livestock, which kind of, Brian, what you talk to, manage that risk. You talk to manage your expenses, and Bob, you said manage your income. So Bob and Brian, where would you guys go if you're starting for information sources?
Well, I do like where this is going. We live in an era where I can Google anything I want. I can go online and get some information off the internet. And that's not a bad place to start. But what I'm going to emphasize is you're going to want someone in your local community that you have a relationship with, that you trust. And part of the reason is because, particularly in the cattle business, because of forage differences geographically and the segment of the industry that we're going to be in, and market fluctuations. Any global advice that you might get on the internet may not be optimal for your specific situation, either geographically or niche or whatever. And so I'm going to want some local people, so local veterinarian, local lenders, local extension people that are going to provide as specific of information for me, and then I'm going to have the relationship with them to explain exactly what I need.
Bob kind of took part of my Dustin took where I answer, which is I think it depends. So the question just says I'm new to the beef industry, right? So it doesn't say, does this person have a background in agriculture, or maybe they've got the crop side covered and now I'm just adding that on to an operation. But I think, a core team, if you're going to start a new beef operation, is going to be an accountant and a banker. Maybe that has some overlap there, but somebody that can handle the economic side, probably a veterinarian, probably a nutrition. I think that's the bare minimum of people you want to either assemble, or if you have knowledge in those areas sufficient, then that's probably fine. But that would be my recommendation, bare minimum for a team.
So put together that team, and then kind of as you described, you have to have that entrepreneurial spirit to be willing to go out and seek other information as well as deciding what information is valid. So I'm gonna go back to the question, new to the beef industry, advice for growing profit. And now as we're kind of wrapping up here, Dustin, 1 or 2 sentences of advice to somebody new to the beef industry.
So if you're new in the beef industry, if you're just getting into this, we've already kind of hit on some of the big things that I think, Bob talked about efficiency. I talked about cost, risk management. You've got to document those numbers. So start recording data. So that way you can go back and look at your reproductive efficiency. That way you can go and track your costs. If you want to participate in some kind of risk management program, you need to know what your break-evens are. You need to know that information. So document.
Bob?
One thing is maybe just even embrace the fact that you're new. That gives kind of fresh eyes, because one of the things that can be, you talk about an entrepreneurial outlook. Sometimes where entrepreneurials thrive is to actually kind of do things differently than other people. You need to do things well, and a lot of new ideas aren't necessarily better. They can be. And so if you come at this, I want to build a beef operation that's profitable, and you come at it with fresh eyes, that's just an advantage that you may have.
I'm not sure that was 2 sentences, Bob.
I'm pretty sure it wasn't.
Brian?
I'll say have the right expectations of how hard you are going to work, and not just physically, but mentally. You're going to learn a lot of new skills, a lot of new things. So proper expectations for your input physically and mentally.
You guys are great, because this is, if you're coming into the industry, this should get you fired up and thinking about there's opportunities. It's very doable. There are some of the things that you can put together that team so that you've got some of that expertise. And then dive into costs, revenue, and how do I manage those risks. Thanks for joining us. As always, we'll be on the BCI Cattle Chat podcast. If you have questions, comments, or thoughts you'd like us to talk about, you can send us an email at bci@ksu.edu.
Once again, those were K-State experts Brad White, Brian Lubbers, Dustin Pendell, and Bob Larson for this week's BCI's Ask the Experts. We'll be back with more shortly on Agriculture Today.
This is Agriculture Today. Along with Samantha Bennett, I'm Jeff Wickman. We end today's program with this week's Milk Lines. As another year comes to a close, K-State dairy specialist Mike Brouk encourages producers to meet with each employee about their role on the farm. He says, though, that this needs to be much more than just a critique.
Today I want to visit with our Kansas dairy producers concerning the evaluation of their employees on the dairy farm. As we approach the end of the year, many of our farms will be conducting annual evaluation for their employees. If you do not do this on your dairy, this might be a good thing to start. As we think about evaluations, a lot of times as a manager, we tend to think about the things that each employee needs to improve. So when the employee comes in for evaluation, it's really more about what they maybe could do better, maybe what they haven't been doing right. And in the end, it's not a very positive environment for the employee. Now, it is important for management to communicate to an employee when improvement is needed. But when we sit down for evaluation, it needs to be more than just about that. First of all, this is really about the employee. Understanding that each employee is different and each employee is living in a different situation, has different responsibilities on your farm in many cases. They have different challenges. So we need to think about this as an individual. So as you think about that, you need to think about how you're going to structure that evaluation. What do you want to start with? I would encourage you to start with some positive things. Each of your employee has things that they do well. Whatever those right things are, those good things, those things that make them a unique employee, talk about those for just a couple of minutes. Then, with each employee, we obviously have things that we would like to see them improve. And it could be, simple things. It could be things that are actually going to require some training. So when we start talking about things that an employee should improve, as management, we need to think about how do we want our employees to grow. Well, if we want our employees to grow, what things do we have to provide so that they can grow? So as you start talking about the things you want your employee to improve on, maybe there's some training. Could be online. Maybe it's some articles that need to be read. Have these things ready in advance so that you can present them as you talk about things that you would like them to improve. This will help them understand that you really do care about them as a person, and you really are trying to help them become better at what they do. It's always important during this time to spend some time listening as well. As you present what you would like to see them improve and maybe some suggestions on how to improve that, they may have some thoughts of their own. Take that into consideration as you maybe build a plan for training that you'd like to see them do in the next 3 months or 6 months. Or maybe there's a conference or some sort of training that they need to go to. Maybe it's something like milker school, or maybe it's hoof trimming. Start to plan those things out as you look at the things that they need to improve. As we get toward the end of the evaluation time with the employee, there's a couple of things that I think are really important. You started out with something positive or several things that were positive. You talked about some improvement areas. Now let's finish on a positive note. Again, what are some unique things that they're doing on the farm that you really appreciate? These need to be different than the first things that you mentioned. Now, finally, you need to give them the opportunity to talk a little bit as well. Maybe ask them questions like, what would you like to see different about the job that you're currently doing? Or do you have certain aspirations that you would like to maybe move from a milking position to a feeding position, or from a feeding position to a milking position? Or what kinds of things do they see that would make them a better employee? This is Mike Brouk with K-State Research and Extension, encouraging our dairy producers that end-of-the-year evaluations are very important, and it's very important as a manager to spend some time pre-planning so that you can get the right outcome as you go through this evaluation discussion with each of your individual employees.
Thanks, Mike. And that'll do it for the Tuesday edition. In advance of the Thanksgiving holiday, Agriculture Today will not air tomorrow, Thursday, or Friday. Samantha and I wish you all a happy Thanksgiving as you gather with family and friends. This is the K-State Radio Network.